Hello and welcome to Crux Investor. We spoke earlier today to Akiba Leisman, who's the CEO of Mako Mining, their TSXV gold developer with assets in Nicaragua. And if you want our thoughts and opinions on that conversation, and indeed the company itself, you can find that at cruxinvestor.com/club. You can also find detailed company reports, market commentary from experts from around the world on a variety of commodities. There's also training videos on there. There's summaries of other interviews that we've done. And there's a big thriving community of investors sharing their thoughts and ideas with each other. And if you go there now and sign up for the waitlist, you get a 7-day free trial. And of course, we'd love your thoughts and opinions too. So do leave a comment below, give us a like. And if you want to see what we talked about, take a look in the description. Akiba, how are you doing, sir?
Pretty good, Matt. How are you?
Not bad. Long time. How have you been?
Busy. Lots going on.
Yeah. Where are you? You're in New York, obviously. You haven't got back down to site yet.
Correct. New York, which was pretty hard hit in March, April, May, did calm down pretty dramatically during the summertime. It's starting to have a minor second wave, but really nothing like we were experiencing with respect to the pandemic in March or April. But I do work from home. It's good to see some of our guys being able to travel on an airplane down to site, and I can't wait to get back down to Nicaragua for first gold pour.
Fantastic. I'm looking forward to hearing all about it, actually, because we haven't spoken since beginning of June. It's everything I can do to stay away from talking to you about American politics. I'm desperate to do it. Only a couple of weeks to go. Exciting times. So let's not do that. But let's instead give everyone who has not heard the story before the 1-minute overview, and then we'll kind of pick it up from there.
Sure. So Mako Mining is doing 3 things in northern Nicaragua. We're in the middle of building what will be the world's highest grade open pit only mine, scheduled first gold pour in January of next year. Secondly, we are exploring a satellite deposit called Las Conchitas with the objective of bringing that into the mine plan by late 2022. And then thirdly, we do think that we're sitting on an orogenic gold mining camp. The regional exploration is fantastic, and we can't wait to be into cash flow to start really unlocking the code of this orogenic system. Okay,
so obviously we spoke in June. A few things have happened since then, so maybe we're going to run through that. But the main meat here today is the mineral resource estimate, which I do want to talk to you about. But let's kind of catch me up and catch some of these guys up on what you've been up to. One of the first things you did after we spoke was you kind of set back the pour date.
Correct. Initially in March, when it became apparent just how serious the global pandemic was going to be, we took back our original first gold pour date from September of this year to Q4. And then right around June, maybe a couple weeks after we spoke, we further refined that for a couple week delay when we got clear understanding as to what the rules of the game were in terms of travel back and forth to site. I can say that our operating team has been able to get in and out of Nicaragua since August. So if anything, there's been an improvement to that refined schedule that we discussed in June, and we're well on target for first gold pour in January of next year.
Okay. So we shall see if you're hopefully able to hit that target. Next thing you did, you raised some money, a lot of money actually. Was that quite easy in this market?
It was interesting, right? So we raised a net US $20 million. When we put that first delay to the project in March, it was about a month after we took a $15 million unsecured facility from the controlling shareholder. And that should have been just enough capital to get us to first gold pour, not even commercial production, but first gold pour. When it became clear that this project was going to be 3 to 4 months delayed, it was clear that there was going to be a funding gap if we were going to be continuing our exploration work over at site. And then really for the first time ever, we were going to need to fund a 3 to 4 month ramp up from first gold pour to commercial production, which we're anticipating happening in early Q2. So we estimated that funding gap at about US $12 million, all of which was provided in the form of equity by the controlling shareholder, Wexford Capital. And then we opened it up to a bought deal led by Stifel GMP to see what kind of appetite there was to limit the amount of percentage accretion that the controlling shareholder would have of the company. Stifel thought that US $8 million net was a good number. So we did raise that to broaden out the shareholder base, and we're using that as a buffer to our balance sheet. We've since increased a little bit of our exploration spend, and we anticipate having about US $5 million on our balance sheet in excess by the time that we're in a net positive cash flow.
Okay, I'm interested in getting into the story about that you sold into these guys, but we'll do that in a minute because I just want to whiz through the news release stories just to put everything in sequence, and then we'll sort of come back to that. So the other thing we have seen is a lot of high-grade drill results coming out, exceptional.
Yeah, it's been fantastic. So we had two simultaneous drill programs going on. We had what eventually became a 24,000 meter infill program at the San Albino mine, and we'll talk about the resource that came from that exercise. We've also had now in excess of a 20,000 meter true greenfields exploration program at a satellite deposit, or soon to be deposit, a couple of kilometers to the south of San Albino, an area called Las Conchitas, which looks a lot like San Albino right now. Very similar grades, very similar structures, very similar geometries, and we do anticipate that with a substantial infill program that we're going to be starting when the mine goes into cash flow next year, that we'll be able to bring that into a mine plan in the back half of 2022. Okay,
so lots of drilling. You got the cash to do it. A lot more work ahead of you. First gold pour, Q1. We'll go with January, Q1. January. Okay. So let's talk about what you were saying to the institutions when you raised that money. What were they buying into?
Sure. So we let everybody know that there was a very substantial difference in terms of how we were mining this deposit versus what was modeled before with respect to the resource. So I think everybody was going to anticipate some of the changes. Now, a few things, the net effect of that is that there was a material increase in the grade of the deposit. And we'll go over some of the mining techniques as to why that's the case. But really, everybody was buying into the fact that this is just going to be a bootstrapped approach to get a mine up and running. It'll be the highest grade open pit only mine in the world. The cash flow that will be generated from that will go and delineate a second deposit called Las Conchitas, as well as exploring for any realistic target that we have on the rest of the 188 square kilometer land package that we own right now.
Right. Okay. So the 2015 PEA was, I think, to use your own phrase, was perhaps a stretch, over optimistic.
Yeah. You know what? I was actually more critical about P&E coming into the original investments that the predecessor company made in 2014 that I am now. Right. So I think it's very clear that there was no funny business that was going on with P&E and how they
I think you said they were generous in their extrapolations.
Correct. Yeah. So let's break apart the geology in terms of what's real, what was being modeled before, and then some of the choices that were being made in 2012, 2015, 2019, and 2020. Right. So the reality of our deposit. Let's start with real, and then we'll go to modeling. We have a series of very high grade but very narrow veins that have a shallow dip across our property. And that's on San Albino. We have 3 primary veins there. There's probably another 2 kind of scraggly little veins, but they all basically are very high grade and very narrow. By very high grade, I mean well in excess of a ½ ounce material. By very narrow, they tend to average somewhere between 1.25 and 1.5 meters wide. Now, on top of that, there is a geochemically distinct hanging wall and footwall that generally is grading about 1/4 gram, so sub-economic material. But it's very clear that there's a difference between the hanging wall and footwall and the country rock of this deposit. On occasion, you're going to find little stragglers that will spike the grade locally in these hanging walls and footwalls that will make individual areas economic. But by and large, you have a narrow vein and a wider zone. Now, back in the 2012 and updated 2015 resource, everything was being modeled as a single unit. So forget about any fancy geostatistics, which we'll go into in a second. Just arithmetically, that has the function of overstating the tons of the deposit and understating the grade, right? The way that we are modeling this right now is how we are mining it. And the way that I like to describe it through an analog is basically peeling off layers of a layer cake, exposing the frosting, mining all of the frosting and trying to take as little cake as possible, basically going after the high grade vein. So what we did internally in 2019 and handed it off to Mr. Ristorselli from MDA, Mine Development Associates, in the early part of this year, and then finally the resource came out, was modeling it on that. We're modeling the high grade veins and applying a reasonable and conservative mining dilution factor around either side of about a half meter. And we're mining right now tighter than half meter tolerances. So by definition, the grade of the deposit needed to go up. Now, the adjective that we use in the press release called generous in terms of what P&E was doing is very clear that the resource and the domains that were drilled out were representative of where the drill holes were. So they weren't really making up anything, right? So this had data that went into the resource model. However, when you were talking about the full thickness of that domain, so the high grade vein, the hanging wall and footwall, yes, they were being a little bit generous on the size and thickness of that area, but more importantly, and this is where the fancy geostatistics come in, by not constraining that high grade from that narrow vein into the full domain, it was clear that they were overestimating the amount of gold within that larger domain as well. Now, on top of that, we took a very, very big pullback on where the data was permitting us to look for ounces that we can say are eventually going to turn into mineable ounces, whether it's going to be reserves or things that are going to be directly into a mine plan. The only area that we focused on San Albino was effectively the first 120 meters from surface. So any underground drilling, any deep drilling that was done prior to 2019, we took a much more conservative view on how those blocks held together, such that there really aren't any material inferred ounces within the underground category. You basically just eliminated everything and then only took what we could say is part of a real underground mine plan. And those are really the differences between the models themselves. So I do think that P&E were doing things appropriate when it came to 43101 compliance, but it was clear that they were being generous on how they were modeling these things. And by not modeling it in the way that we're mining it, or even in the way that the geology lies, you're going to wind up causing an overestimation of the ounces within the deposit.
Okay, thanks for that. And Steve Ristorselli or Celli, is he a mining engineer or is he a geologist?
Geologist.
Geologist. So don't mining engineers normally determine what can be mined?
Oh, sure. First of all, it's a team of MDA, right? So there's a full team.
See, he's one of the competent persons.
And he was the guy running the show. So that his name has the big signature, as well as mine for that matter, on this report.
Right. Okay. So a mining engineer has looked at this and defined the block model.
Yep.
Got it. So I think we can park the 2015 PA, you're parking, and I think that's possibly some of the problem you're experiencing or seeing or hearing in the marketplace. People are a little bit concerned about the new mineral resource estimate. It seems to be. It wasn't the reaction you wanted.
I don't know. Anytime that we have real data that goes out to the public, let the marketplace decide what the value of the company is. So, I mean, the way that I describe this is that we're trying to execute on our 3-stage plan: San Albino, Las Conchitas, orogenic gold mining camp.
Yeah. Truly,
the only thing, and I'm actually ruthless about it, the only thing that really matters to me is the long-term move of our stock price. And I think that's going to reflect how we're able to execute on each one of those 3 strategies. But if the market sells off because we're putting out data that is real, so be it. I don't actually want shareholders like that. The only thing that I can do is state our best case with a little bit of a conservative lens on that. And then the stock price will do what the stock price does as we execute.
Okay. Well, actually, so let's talk about dilution. I mean, how are you treating that?
So it goes back to I don't mean to belabor this dessert analogy, but it really is kind of important on how we're mining it, right? So actually, this is another good example. So first of all, we have 4 layers of grade control, and there's going to be a punchline that I'm about to say at the end of this. But 4 layers of grade control. So we have the resource estimate that's really constrained mostly by drill data. So number 1, we have core holes that are going in to define the resource. Number 2, when we're actually opening up a mining bench, we have blast hole assays that are a good proxy for defining geology, but are really bad when it comes to estimating the amount of ounces that are in the ground. And we can go over why that's the case in a bit. Next, we have our geologists that are taking channel samples every 4 meters apart, which is actually very good at doing an estimate for the in situ grade of the veins themselves. And then finally, when the mine turns on, we'll have a belt sampler, which will determine what the grade is going into the mill for metallurgical purposes. Here's the punchline. We have not had our internal on-site laboratory pass our QA/QC level as of today. Hopefully that's going to be rectified over the course of the next 2 weeks. So even though our lab has been turned on since May, we are not getting the QA/QC that we need from that lab to run this mine. Everything is going off-site, which means we're effectively mining this without real assays. And the reason why we can do that is because there's such a sharp contact between the hanging wall and the country rock and the vein and the hanging wall. We are effectively, not entirely, but effectively mining this visually. Having looked at this for the last 4 months, this would be a problem on how we're mining this if we did not have this sharp visual distinction between the vein, the hanging wall, and the country rock over here. It is a huge benefit to how we're managing this. Now, given that, we have, as we open up the benches, once we have those blast hole assays back, we have a grade control geologist that literally is standing in that open bench, and he will be demarcating where those contact points are with a can of blue spray paint. And we're telling a very highly skilled excavator operator to scrape off layers of that layer cake until you get to that blue spray paint, and then that blue spray paint is going to be mined as one. Now, there's going to be areas which will, in the hanging wall and footwall, that will spike above cutoff grade, so we'll take that too. But principally, we're trying to limit the amount of hanging wall and footwall that's coming out from the mine itself. And then once we actually get back these assays, and we've gotten back 1 full bench of mining assays from an external lab on this, it's perfect, right? Everything that we mine in the high grade is high grade. Everything that we mine in the low grade is low grade. And it allows us to operate at this level. Now, I can say for the first couple of high grade mining benches that we've been mining much, much tighter than a half a meter. I would probably estimate it as probably about 0.3 of a mining tolerance right now. And in terms of how that resource is being delineated, when we report that 9.54 gram fully diluted grade, that is assuming a half meter tolerance of mining dilution. Anything below that, it means the effective head grade of the deposit's going up.
Okay, so how long did it take you to mine the first full bench at San Albino?
Right, so the first bench where we were operating on one face while we were in the quote unquote ore took us about a week. And I think we were probably running on average when we were in the ore material about 120 tons a day. The second bench, it actually wasn't even our intent, but it kind of just worked out this way logistically. We were able to mine from either side of the bench. We were actually mining 2 mining faces simultaneously. And then because the vein was slightly wider than we experienced on the first bench, we were actually able to push this higher than 300 tons a day when we were in that quote unquote ore material over here. Our estimation, because our target point for commercial production is 500 tons per day. Yeah. So long as we are at 3 mining faces at a normal level of thickness, we'll be there, hopefully without any problems.
And how did that grade compare to the resource model?
Right. So in terms of the first one, so the first bench is the only thing that we have. I think we reported an 11.7. Preliminary numbers, I actually still need to do the final reconciliation on it, but preliminary numbers looks like we were in 4% in terms of the number of ounces. So we were about 3.5% under. And then the grade was spot on. I think we were estimating about 11.8 and we got 11.7. I will say in this particular zone, there was a slightly larger void than what we were modeling before. If that void was of the same size, we would have been positively reconciled on both.
Right. And what's the dilution indicate?
Right. So this is one where I've never had a good way of calculating a percent of dilution, right? And the reason for this is it's not like we're taking a vein and then just getting like scrapes of the hanging wall and footwall over here. There are going to be components of the hanging wall and footwall that are going to be higher than cutoff, and we are pulling that out as well. So on this 11.7 gram bench, the actual vein was grading about 18 or 19 grams, I would say. But it's not like we were experiencing 35, 40% dilution on this bench, because there were areas that we wanted to mine in the hanging wall and footwall intentionally. So I still haven't gotten a good clear, concise way of coming up with a percent dilution to give to investors, which is the reason why we only talk about fully diluted grades.
Right. Okay. So let's come back to the scale component here, because obviously there's been a reduction in the resource. What the market's going to want to know, that this isn't some sort of Icarus type company which is going to burn itself out in 2 years. You're going to have to replace those ounces. You're going to have to, build on those ounces. And so again, if I come back to the institutional guys, I appreciate Wexford is a major holder here, but there are also some new institutional guys in here. What's the news story for them? Because given, that was back in July, things have changed. You've learned a little bit more about what you've got here. What's the plan moving forward to make them feel comfortable that you are going to be able to make this sustaining?
Sure. I mean, the thesis behind Mako, whether it's mine, Wexford's, or even how we present to investors, institutional or retail for that matter, is the same. Is that for Mako to work, there are three things that we need to do. We need to build a mine. We need to expand it to show that we can actually have some sort of material scale operation in the global scale of mining. Let's call it 75 to 90,000 ounces a year, is just as a number. And then to show that there's going to be longevity associated with that. If we're not able to execute on any one of those, the underlying thesis behind Mako is not going to be as successful as we underwrote this. So that's first and foremost. So as an investor, you're always going to try to be handicapping risk associated with each of that. We try to eliminate as many risks as possible on the mine, right? So the mine is built, right? So everybody can see my pictures and the updates on my Twitter feed. You can see that we're like 90% done right now. We try to eliminate as much of the uncertainties around this, certainly with the resource that came out, and certainly with some updated metallurgical work that we've done over the course of the last couple of years. So hopefully that has a limited amount of risk that people are underwriting. The exploration side is different. Now, this is the way that I.
Well, can I just let's stick with the mine component first, and we'll bounce through each of those. So on the mine, you've got a permit now. I read that you've got a permit now to do 1,000 tons per day. Is that right?
That's right. So
can you feed that entirely from the open pit, or do you also need some underground to help you out there?
So remember what I said before, is that if we're at reasonable levels of thickness, 3 mining phases at a minimum to get to 500 tons a day. So to get to 1,000 tons a day, you need 6. We can't find 6 mining phases at San Albino, right? So full stop. That will require literally a second deposit to go and feed the operations from Las Conchitas. So I don't think you can. There may be like random months where we're mining 1,000 because we're average thickness is wider and we have some stockpile that we can go through. So
what level? What level? 500?
I think 500 tons a day is very achievable. Like
okay.
In
how many ounces does that give you?
It depends on the grade itself. So if you were going to be assuming that this is a 9.5 gram a ton mine, and you're going to be running this at 500 tons a day, and you're going to be banking in recovery factors that we estimate somewhere in the low 90%, and you're going to be able to do this for a full 365 days. And remember, we're not planning on being in commercial production until early Q2, so that will equate to a very, very high 40,000 ounce a year run rate. But all of those things need to happen.
Right. Okay. I'll come back to that. That's fine. Okay. Exploration.
So with respect to the permit on 1,000 tons a day, so that requires Las Conchitas. I think in all fairness, I was actually expecting the permit to not come for another year. So we applied for that permit early, and it shows the clear approach that the Nicaraguan government is taking to try to get operations up as quickly as possible and at scale as possible. And it shows their support for mining that permit was given to us. Other than removing any potential bottlenecks that we have over at San Albino, it's not going to be a permit that we can really utilize for the long run until at least the back end of 2022.
Okay, so that's great. It gives us a number, 40,000 ounce company, market cap?
185 US. I think that's kind of like the number.
Right. Did you say that's kind of up there for a 40,000 ounce producer?
Well, right. That's the frame, right? So the frame is, if the only thing that we had was San Albino, right? And we were going to be, and at 9.5 grams, which we actually think is a very real grade. That means at the high end of 40,000. So I don't want to say 50, but definitely above 45,000 ounce at 9.5 grams. At that kind of level, then sure. To me, San Albino is only one component of this. In fact, I think I even mentioned this to you in the last call that we had in June. To me, in terms of, people can put the notional value of the company that they want, but at least from a percentage NAV, which I think I'm actually pretty right about, I put San Albino at somewhere between 20 and 30% of where I think the overall value of Mako should be. Now, the importance of San Albino, in addition to actually demonstrating with this resource that we have the ability to mine something in all honesty is a fairly unstandard way of going about an open pit mine. And hopefully we've put enough information out there to investors that this is a credible approach, both in terms of how we're modeling the resource and how we're going to be able to mine it at 500 tons a day. That, in doing that over at San Albino, it basically lowers the threshold of success for everywhere else in the property. If we're able to find, let's say for argument's sake, in terms of your valuation math, is let's say we were an exploration company, right? And we had a high grade, small scale pocket of resource here, there, or elsewhere on our property. You can put whatever valuation you want on it. $50 an ounce, $100 an ounce, $200 an ounce if it's at the extreme. The second that you actually have a mine and you're able to put any ounce, forget about on our property, with at a maximum, it's going to be 25 kilometers of hauling distance at the top end of our property. If you were anywhere within 300 kilometers of our property, you'd be able to truck this economically. Anything that you find with grades like we're finding over at San Albino is clearly worth in excess of $1,000 an ounce to us. So it lowers the threshold of success for what we're able to find on the exploration front elsewhere on our property. Now, a lot of the context behind how this company was developed after the merger, then after the management changes initially in March of last year, needs to be looked at in the context of where we were trading at that time. Is that before we actually made the construction decision over at San Albino, we were a $35 million market cap company. And we had to go through all the work. It was a 19-month process to get this resource up in line to make sure that we were comfortable with how we were mining it. So that work, that capital in aggregate amounted to about $37 million to get us up and running, was there, and it was a decision that was made last year. But we are going to be reaping the fruits of that decision simply by lowering the threshold for success for all the other exploration ounces that we could potentially find on the property. But no question, an investor needs to understand that exploration companies by definition are risky. We're just trying to lower, let's say, the effective strike price of that call option on future exploration success.
Okay, so talk to me about costs. What are you putting the AISC in? What are you looking at? Being able to lower that down to across the year when you start producing at the rates you suggested.
Right. Now, I don't want to pitch and catch on 43101. So we pulled the PEA because the underlying bones of that PEA was based on a resource that we've now updated, and this supersedes it. So we'll talk conceptually about what the costs are, because we actually have started to mine the high grade, and we've been sporadically mining since February of this year, and in the high grade pretty consistently since August. We have a single shift right now. Our marginal cost of open pit mining is $1.98. Right, so that's why in the resource model we had a $2 marginal cost for the pit design. You burden that with everything: oversight, loading, handling, rehandling, explosives, everything. With a single shift, it's costing us, and this is real mining, the real invoices, is costing us about US $2.60 a ton, fully burdened and all in. We said in that press release with that resource that we anticipate meeting or exceeding that 9.54 gram fully diluted grade of that open pit. Given that, even if this was going to be an absurdly high strip ratio mine, you can put whatever number you want. Let's say for argument's sake, it's going to be in the 20s somewhere, right? So at that level, you're still talking about something that from a mining cost will be in the low $200 an ounce. That's it. And then on top of that, you'll put your processing cost in that resource calculation. We put 60, which is our anticipated steady state costs at 60 at 9.5 grams. That equates to another $200, a C1 cash cost for an operation like that, assuming those numbers would equate to something in the low $400 range. You burden that with royalties, you burden that with taxes, you burden that with sustaining capital, which is really nothing more than an amortization of additional tailings capacity. And then you're probably looking at something that will be in the low $700 when all is said and done. Again, conceptually.
Conceptually, okay. Okay, so you'll be making money at those rates, even if you're off.
Oh, yeah, no doubt about that.
Right. Okay. So that's good news. So small mine, 50% capacity first year. That's fine because that brings in there's matter. Well, we can all work out what that potentially could bring in if you start selling next year. Let's assume you do. You've got some cash flowing. Is that what the institutions want to hear? Because you're kind of, again, it's kind of a little bit playing catch up. It's a little bit trying to, because you're going to have to pay for the exploration component. Because this mining kind of, for me, kind of levels the playing field a bit. But the exploration is where people should be getting excited.
100%, right? No question. I think there's a limit to our logistical capacity to spend the money that's coming from the mine. Like, I don't think there's so many targets on our land package that it's really not a limit of targets and thresholds for expected returns on exploration programs that are limiting us. It literally is how many geologists do we have? What's the size of our core shack? How many saws we have with the ability to process things? To put that in perspective, when we were in the real meat of the infill program from last year, we were running 6 rigs. That was beyond our level of capacity to process the data based on the staff that we had last year. We're obviously going to be fixing some of those logistical issues. I would say at a minimum, we're going to be increasing from the 1 rig that we have today. We're actually going to be going up to 2 rigs next week as well. And then at a minimum, we're going to be at 6 rigs by the time that the mine really turns on. But even at 6 rigs, you're not talking about an exploration program that's going to be more than, let's call it $8 or $9 million a year. It's actually very difficult to come up with a budget that's going to be a bigger number like that. And again, that's not because of targets. That's just because of what we're capable of processing from a data perspective.
I'm trying to get a sort of sense of where your numbers are at, because again, there's so much legacy stuff going on here. Are you taking all of the money from San Albino and just plowing it back into exploration? Is there anything? Is it just reinvesting and plowing money straight back in the ground? In which case, where's the upside for shareholders? But you're kind of outlining a sort of modest exploration program there.
Yeah, it's not. I mean, that will be going to put this in perspective. Like on that resource that we put out, it's only on 240 meters of strike, at least in the open pit. I think if you include some of the underground, it winds down a little bit from a strike perspective. But just on the open pit, where most of that infill work was done, it was 240 meters. Over at Las Conchitas, we've already publicly stated the open pit strike potential on that is at least 3 times the size over at San Albino. the inventory of drilling that we have everywhere on San Albino, open pit and underground, is just under 80,000 meters over there, just to delineate this in a structurally controlled way. A lot of that was like figuring out the model. So I don't think we need to have as much drill density elsewhere as we do over there. But at a minimum, Las Conchitas is going to need, just to get started, a 75,000 meter program over an 18-month period. So yes, there's going to be a lot of exploration that's going to be done, but the pace of exploration that we need to do in order to be able to process that kind of data is going to mean that the amount of cash that we're generating from the mine is going to be far in excess of what we're actually capable of spending. If I had my druthers, I would rather do like 5 years of exploration all in 1 year, so we actually have the data to build a program around. But it's just not feasible to do that. So this is going to be a company that will be generating a lot of what is effective free cash on the balance sheet.
That's the bit I'm kind of want to get excited about, but you've got a long way to go to be able to deliver that, right? So again, the institutions must be looking at you, the market must be looking at you and going, you've got a bunch of baby steps to deliver, to prove that this is probably a change of management, it's a change of attitude and a change of approach, more importantly, to the asset, because San Albino is, forget the checkered past, but it's got to be approached the right way. You've got to make the right assumptions. You don't get a second chance if those assumptions are wrong again, right?
No, 100%. So a couple of things to that. Looking back at forget about the pre-Mako, we can go over that as well. But on what I call day one of Mako, which was mid-March of last year, where, all right, we got the management change, and then, or at the very least in August of last year, where we had the permanent management change, where I took over as CEO, and then frankly kind of eliminated some, shall we say, factions over at the board, so that we were kind of swimming in the same direction. So depending on how you count, this business over at Mako either started 20 months ago or 14 months ago. We've been doing a lot, right, in that 12 to 14 month period. I don't think there's actually anything that we could have done to accelerate anything that we could have done, or the decisions that we were making over the course of the last 14 to 20 months. And the same thing is going to be going forward on the next 2, 3, 4, 5 year strategy as well. We don't like to wait, right? So we're trying to do things correctly with the right levels of data, but also the right levels of urgency. We would like to have investors that will come along for the ride as we execute on that strategy. But I'm in full agreement with you. There's actually a lot for us to do in order for us to execute on the 3 legs of the stool, which is building San Albino correctly and making sure that it's mined the correct way, that it's modeled the correct way, that we have a good handle on that, applying that model to our next deposit over at Las Conchitas, doing that so we can get this up to a much more reasonable mining rate in the context of global mining. And then thirdly, being able to explore and be successful at exploring the rest of our land package, because there's certainly targets to demonstrate the success over there. But all of those require capital, it requires expertise, and as with any exploration company, it requires luck to be successful.
Yeah. So just again for current investors looking at this, what's that runway look like? Because you want to go. You are going high speed internally, but you're not going high speed as far as the market is concerned, because you can't. You've got to do things in the right way, okay? So you've got to get to the point where you can feed the mill, right? And that's going to take, say, the drill bit, some luck, some expertise, and hopefully you find what you want to find, and you're chasing more high grade veins. Great, but that'll take some time. So have you got a sort of sense of, in your head, of how people should be viewing this as a regeneration story? How quickly do you build up? Yeah,
so to put it in context, we're about ready to finish off an internal 3D model on Las Conchitas. So it actually is fairly advanced on the exploration side. And with that, a normal mining company would be able to put out an inferred resource. I think today, a relatively small one on Las Conchitas in terms of where we're drilling right now. with that, that's the kind of data, and I think what we did with MDA is illustrative of how we work on this. Is that when the initial management changes happened in March, it was actually one of the best press releases that I wrote, because it was like 4 sentences and that was it. It was former CEO resigns, we replace him with interim CEO Akiba, and we start drill program. That was it. So that was the press release that happened in March of last year. It took us with what grew to be about a 24,000 meter program to get our internal model set, and that was with a good 8 years of runway back from the Golden Rain side of things over there. And then once we were comfortable with how the model behaved, we gave that over to Steve Ristorcelli from MDA, and he mentioned this. This was like the first time that he's ever seen a junior mining company give him a geological model that he didn't have to redo from scratch. So we do good work over there. And right now, to put that in context of where we are over at Las Conchitas is basically where we were a few months prior to March of last year. So there is a runway before we can even get a maiden resource on Las Conchitas. But we're trying to do things as prudently, as effectively, as professionally as possible. I have no issues of getting interim updates. We put out all our holes are on our press release. Glad to give talks like this to go over the details on how this is behaving. But until we're actually comfortable with the model, and then until we give that level of model which we're comfortable with to a third party, there's a limit to what we can actually put out there in the public domain in terms of resource.
Exactly, and I guess that's part of the constraint that you're working in, because one of the first things we talked about here was people are not seeing the scale, and you're going to have to start addressing that over time. So in your head, are you saying, I'm going to be putting out regular resources? It's costly, it costs time, etc. But is that what you're going to need to do? Or do you think you've got the confidence of the market to be able to say, hey, give me a year and we'll put out a resource on Las Conchitas, because we want to come to the market with something sizable and show you that we've got this scale? How do you come at it?
No, I think there's a lot for us to prove, like both historically in nature, and I think both sides of the equation had an equivalent credibility gap for different reasons on the Marlin and Golden Rain side of things. So part of the exercise over the last year and a half is to earn back some of that credibility currency, which I think we've actually been fairly decent at doing. I don't think we're certainly not the type of group saying, oh, trust us, do this, give us money to do over that target. We've clearly not demonstrated our success on that. Even with respect to the capital raise that went on in June, I would say the principal reason why we were able to do for the first time in either company's history, on either side of the company's history, a true syndicated bought deal, I don't think had really anything to do specifically with us, our approach, or even to a certain extent the asset. I think it was just because the gold tape was pretty attractive in June. So we're not there yet on getting the full buy-in for the market. That's okay. It really is on us to execute. Now, in terms of putting out interim resources, I do believe, and actually you saw this in terms of what Steve and I put out with this resource estimate, is that I do think it's very important to frame things correctly. Is that when you're putting out a document, you're putting out a document which is your best guess on what's there. If you're putting out a document where you're leaving the constraints of the resource open, it doesn't do anybody any benefit. So we're going to be open, but until we actually have the constraints, not of the entire Las Conchitas property, but of the areas that we're drilling. Like we just need to find the constraints of it. And as soon as we find the constraints, then we have no issues putting out an inferred resource that we can actually put our stamp of approval on. Because it's not even just about drilling here and there and then giving it to MDA to put out an inferred resource. It's drilling it here or there, doing the internal three-dimensional modeling of it, make sure that we're comfortable, handing off that internal model to an external guy to validate our work, and then putting it out. And it takes time to do that.
Okay, just a quick one on, someone asked about Potrerillos. which he picked up. Anything happening there, or is that just consolidating land?
Yeah, so we were able to do our first scout exploration work over there. There's no, and it goes back to that 240 meters of open pitch strike length that we have over at San Albino. You go to the other side of the El Jicaro River, which is probably a couple hundred meters away from the extent of our pit. We've scoped out another 6.7 kilometers of strike extension on the San Albino structure. It's going in that direction to the northeast. So Las Conchitas is very similar geology, but no question it's separate structures and veins because it's to the south. To the northeast, it's the same stuff. Now we've been able to do a scout work, a very detailed prospecting program over there, double-digit grades on a multitude of targets. We've done the same on the northeast of Puerto Rios on ground that we've owned really since 2009, a further extent, which is how the full 6.7 kilometers is calculated. We're going to commission a geochem program on the entirety of that 30 to 40 square kilometers of ground that make up both sides over there. We've been a little bit slow of transferring the drilling permits that Condor Gold had to us on the Puerto Rico side, so we actually aren't able to drill there as of today. We think that's going to be resolved shortly, but at least on our property to the northeast over there, we're actually going to be starting our detailed geochem program, and the reason why geochem is so important is that there's very little outcrop anywhere on our property, but the veins come very close to the surface, 1, 2, 3 meters away. So a layperson could assume that you're going to actually have some really good targets that will be delineated through geochem. The only area that we've actually ever had a real geochem survey done on our property has been on San Albino and Las Conchitas. We don't have a detailed geochem program anywhere else on our property, and it really is just a time and effort. It's not really a large ticket item, but these are the types of investments that our predecessors were just not investing in. Now, it takes some time, right? To do 30 square kilometers of a couple of guys with an auger rig in 4 or 5 meter distances. It takes months to have that happen, but we're getting started on that now.
Good. Okay. This is all making sense. It's making more sense than it did before, not today's conversation. One last question. We talked about Nicaragua. Okay. Jurisdiction for doing business. We know Calibre's down there, and there's some big players down there. How's security? Oh,
great. Like we were operating in Sinaloa, Mexico, where it became, shall we say, uncomfortable to go down there from a personal security perspective. Nicaragua is fantastic from a personal security perspective. There was political violence in 2018 that is really been tempered over the course of the last couple of years. There'll be elections coming up towards the end of next year. We don't really anticipate major changes going on politically over there, but purely from a personal security perspective, it's night and day. Nicaragua is actually one of the easier jurisdictions to operate in. That being said, and I mentioned this before, is that probably the biggest risk to operating in a country like Nicaragua is just because it's small, right? So it doesn't really change much to change the political environment for a country that has a $13 billion GDP. It's really nothing in the context of anywhere. Forget about developed markets, but even in Central America, it's a tiny economy. So small things can make big changes. I've been trying to think of a mining jurisdiction that has as big of a component of their GDP linked to tourism, and tourism being particularly hard hit because of the pandemic. Nicaragua has got to be up there in terms of the most impacted countries in terms of their economy because of the pandemic. It's not even what was happening internally, but also just people's ability to travel from abroad. So I'm assuming their economy has been pretty hard hit. So I think certainly there's risk from tax changes and things like that. But I think that's the case for all emerging markets for that matter. But from a personal security perspective, it's been fantastic. From a government support of mining, it's been fantastic. From some of our competitors that you mentioned, they've been doing a great job of doing things safely and securely in the country as well. So we're proud to be here.
Good. Akiva, I really appreciate that update. I like what you've done. It's more conservative, sure, but it's more honest, and I appreciate that. So stay in touch. Let us know how you're getting on. Some pretty big things happening in the next couple of quarters. So we'd appreciate the call.
All right, great. Appreciate it, man.